Hello there and welcome to this first edition of Oil Market Insights, brought to you from the OPEC headquarters here in Vienna. I'm Eithne Treanor and we're delighted to be able to bring you the first in a series of discussions about trends in the oil business, where we're going to talk to journalists, analysts, economists and opinion makers about exactly what is going on in the oil industry. Now, this first Oil Market Insight is brought to you on the occasion of the 144th OPEC conference here in Vienna. And joining me today, I'm very happy to introduce Margaret McQuail, Senior Correspondent at Platts, the world's leading energy news and information service. Thanks for joining us. And Jason Schenker, an economist from Wachovia Corporation in the US. Now, we've seen a lot of volatility in the oil market since the beginning of the year. So Jason, tell me, where are the price risks right now on this?
Well, in the near term, they're clearly the upside.
Why would you say that?
Well, the main reason is this gasoline demand. The product situation in the United States is critical right now. We've seen inventories draw down for gasoline, and for heating oil, we saw in February very, very cold weather. That resulted in greater heating oil demand than had been anticipated. And for gasoline right now, because the demand is high, because the supply is low, the profit margin to refine has gone very wide. And because you've seen the refinery margin move from $5 a barrel to about $20 a barrel, this means refiners are going to want to produce a lot more gasoline. That's going to mean more oil demand, and all that means upside price risks.
Well, that's a huge increase in just a few months, really, isn't it?
Well, it really happened over a matter of weeks. It turned really fast. You saw the inventories draw down at a pace unanticipated by the market, and because it wasn't priced in, you saw that big boost, and that's affected prices at the pump. We've seen prices in the United States at levels they've never been before in March, and the risks still remain in coming weeks and months to the upside.
And you're looking also at an increase. And of course, all of this then keeping the price sort of in this almost price range bound. I mean, we're seeing 55, 65. Jason, looking at this, I mean, why are we stuck kind of in this range at the moment?
Well, there's a few different reasons for this. The first thing, though, I want to say is about these product drawdowns, that a lot of this, some of it's been gasoline demand. We're looking at a lot of demand. If you're looking at global growth, that's been very strong. It's weaker now than it was last year, and that's one of the reasons we're range bound. But the other thing that's going on, too, is that we saw a cold winter, and you saw heating oil stocks draw down very rapidly. And that's one of the reasons you're seeing this big drawdown. So you add that to OPEC production cuts, and that's created a tighter market supply. Now, with tighter market supplies in place and global growth, U.S. growth, really in most economies in the world, we see growth a little bit slower in 07 versus 06, not a lot slower. Global growth in 06 was around 5%. For 07, we see it closer to 4. Not a big drop, but a little bit slower growth. And that's one of the reasons you're seeing prices at a moderately lower level than we saw last year on average for crude. It's possible we can get a product disconnect, but for crude prices right now, you've got kind of a Goldilocks economic scenario playing out. In other words, playing off the German fairy tale where things are neither too hot nor too cold, but they're just right. You get this economic soft landing, but it's still a landing. The risks, though, are if these product inventories remain tight, you could see things tick back up.
Now, looking at that price range that we've seen at the time, too, even though we seem range-bound, there has been tremendous volatility. And we talked a little bit earlier about this, but where is the volatility in this market?
The volatility is in the intraday market. It's very clear. You can have a day when the price of crude opens at one price and closes 1 or 2 cents off from the open. But during the day, the price was up $1, down $2, up another $1, and ended up closing almost flat. So the volatility is really during the day where you're seeing the trading. And one of the reasons you're seeing this range-bound action is you don't really have a lot of incentive for either producers or consumers to enter the market in large numbers. At $70, you might have producers who want to enter and hedge. At $50, you might have consumers who are interested. But at $60, folks sort of see a number that's kind of middle of the road, and it's not anything too wild enough to draw new participants in and to really move things around a lot.
And given that sort of range bound too, Margaret, on the market, where does it sort of go for here? The producers must be happy with this. If it's sort of staying, it's almost introduced a little bit of stability here, and while there's still enough oil in the market, supply seems to be a little more imbalanced. They can still do a bit better on the compliance, but they're still getting very good price for the oil.
Yeah. the price is pretty much around $60 a barrel, give or take $1 or so here and there, depending on which day you're looking at. And I think $60 is a price that most of them are fairly happy with.
Of course, they're looking at what they're going to do in terms of their own economies they've got. And I suppose getting used to this now, there must be a plan there very much, that there's an awful lot they can do, and they're seeing this type of profit come in. But, you know, talking to many of the ministers and just looking, we haven't seen the big impact on global economic growth that many people thought might be there. So there does seem to be not quite a complacency coming into the market, but I suppose they're quite content with a price like this.
The ministers of the market.
The ministers and all the oil producers.
The oil, various ministers have talked about 60. Yesterday, for example, the Iranian minister said he thought a price below 60 was not desirable. Other ministers have said, yes, 60 is a good number.
And really, if you wanted to know how people are perceiving this, $60 a barrel seems to be the new 30. So that's the market has become accustomed to this. Central banks aren't worried about it for inflation purposes. Economies aren't coming to a grinding, screeching halt. But the question is, can everything remain in balance? And I think that's kind of the bigger question.
And can it? Looking at it from an economist viewpoint.
Well, from an economist viewpoint, we see growth this year is a little bit softer in the U.S. and elsewhere. That's a broadly held view, and that's our view at Wachovia. And next year we see growth ticking up a little bit in the U.S. and globally. But in general, I would say that in the near term, those risks really from gasoline demand, from those wide spreads, are going to put pressure on crude, potentially the upside.
And now, looking at the central banks, the interest rate, sort of inflation, there were bigger scares earlier in the year, but we've still seen an increase in interest rates around the world. How's that been impacting it?
Absolutely. Well, higher rates are, we see higher rates from central banks because they want to slow inflation. But one of the results is slower growth. So we are seeing some slower growth, not a lot slower. We saw just last week the European Central Bank hike their main policy rate. We think the European Central Bank and the Bank of England, they're going to raise their rates again to hold off inflation, but not big moves coming forward, which means a lot of the growth that we're seeing right now, it's already slowed. It's not going to slow that much more. So you're looking at growth kind of moving sideways for the next 4 to 8 quarters with somewhat of an uptick in 2008.
So there has maybe been a bit of a shift sort of generally in terms of where the market is really in the last few years. It's not always as predictable as maybe some of the forecasters might be saying out there.
Well, I think that another thing with that is that obviously because you've got a deficit of gasoline inventories on a year-over-year basis, where we normally would anticipate there's a lull in heating oil demand and the driving season hasn't kicked in yet, in between there we might actually find greater gasoline production demand, i.e. oil demand from refiners than we normally would, because you're going in already with concerns about gasoline supply. So that really could put sort of a kink into those kinds of forecasts.
And, you know, we haven't talked about China. Just a quick word in terms of what's going on the Eastern market. We're still seeing some very strong growth there, aren't we?
Yeah, absolutely. You know, a lot of what's happened in the stock market is really a stock market story, and is tied more to a contagion effect and some U.S. growth questions, but is not fundamentally based on what happened in China in terms of Chinese growth. Yeah. We see growth there as being a little slower this year than last year, as we do in most economies, but we don't see any kind of collapse, no major cause for concern. And if we think about what does this mean for oil, well, year over year global GDP growth is 80%, almost 80% correlated with year-over-year oil demand growth. Right. And that means this year we're still looking at positive growth, 4% GDP globally. That means you're going to get a pretty strong increase in oil demand likely. So if we want to think about where do we see prices as this correlates to growth, we see them remaining around $60 a barrel, not only through this year but through next year, and a range of around 55 to 65. If we had to put upside risk, or if we had to put any risk, I would say it's probably upside of that range. But that's the range we see really for the next couple of years. Okay, Jason, well, we're going to leave it there. Thanks for your time, Jason Schenker from Wachovia, and to Margaret McQuail from Platts. Thank you so much for joining us. Well, that's been it here from the 144th OPEC conference in Vienna, and we will bring you these regular discussions on trends in the oil market right here on the OPEC website. So be sure and check in every now and then. I'm Eithne Treanor. Thank you so much.